ExamPrep.School. Wyoming Life and Accident and Health or Sickness Insurance Consultant exam code 12-WY-46 or OPWY46. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. A&H, Field Underwriting Procedures. A&H, Other Insurance Concepts. A&H, Policy Provisions, Clauses, and Riders. A&H, Social Insurance. A&H, Types of Policies. Common Statutes for all lines. Life and Health Statutes and Rules. Life, Application, Underwriting, and Policy Delivery. Life, Provisions, Riders, Options, and Exclusions. Life, Retirement, and Other Insurance Concepts. Life, Types of Policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which characteristic most accurately describes the premium structure of an ordinary whole life policy? A. Premiums remain constant throughout the life of the policy. B. Premiums are payable for a limited number of years only. C. A single lump sum premium is paid at issue to fully fund the policy. D. Premiums adjust periodically based on mortality and interest experience. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is level premiums. Ordinary whole life policies require fixed premiums payable throughout the insured's lifetime, or until age 100, whereas limited pay, single premium whole life, and adjustable premium designs follow different funding patterns. Reason B is not correct. Describes a limited pay whole life design rather than an ordinary whole life policy. Reason C is not correct. Refers to the single premium whole life funding method, not ordinary whole life. Reason D is not correct. Applies to adjustable or universal life policies, not ordinary whole life. Question 2. Which feature correctly describes a 20-pay whole life policy's premium payment requirements? A. Premiums are waived if they have been paid for 20 years. B. Premiums revert to a lower amount in the 21st year. C. Premium payments cease after 20 years and the policy is fully paid up thereafter. D. Coverage terminates once level premiums end after 20 years. The correct answer is C. The correct answer is that a 20-pay whole life policy is fully paid up once 20 years of premiums have been paid, with the death benefit remaining level thereafter. The other options describe premium waiver, adjustable premiums, or coverage termination, which do not apply to a 20-pay whole life design. Reason A is not correct. Mistakenly implies a waiver of future premiums rather than a paid-up status after a fixed period. Reason B is not correct. Describes a modified premium design, not a 20-pay whole life structure. Reason D is not correct. Incorrectly states coverage ends, whereas a paid-up policy remains in force. Question 3. In a single premium whole life policy, how does the cash value behave at policy issue? A. Cash value is immediately equal to the net single premium minus expense loading. B. Cash value grows gradually over 20 years before plateauing. C. Cash value remains level until the policy matures at age 100. D. Cash value decreases over time as mortality costs are deducted. The correct answer is A. The correct answer recognizes that a single premium whole life policy's cash value at issue equals the net single premium less expenses, providing immediate cash accumulation. Other choices mischaracterize growth patterns or deduct mortality costs, which do not apply here. Reason B is not correct. Describes limited pay whole life cash value growth, but not single premium funding. Reason C is not correct. Incorrectly suggests no change over time rather than immediate accumulation. Reason D is not correct. misstates the effect of mortality costs in a fully funded single premium design. Question 4. Which statement best describes the premium schedule of a modified premium whole life policy? A. Initial premiums are lower for a set period, then increase to a higher fixed level. B. One lump sum premium is paid at issue to fully fund the policy. C. Premiums remain level from issue until death or age 100. D. Premiums vary annually according to the insurer's mortality charges. The correct answer is A. The correct answer identifies the two-tiered structure of modified premium whole life, featuring reduced initial premiums followed by higher fixed premiums. Other options describe single premium, ordinary level premium, or adjustable premium policies. Reason B is not correct. Refers to single premium whole life, not modified premium design. Reason C is not correct. Describes ordinary whole life with level premiums throughout. Reason D is not correct. Applies to adjustable or universal life, not modified premium whole life. Question 5. A 50-year-old purchasing a whole life policy is presented with a premium schedule that starts at $600 in the first policy year, increases to $650 in the second year, $700 in the third year, and then remains level at $750 annually thereafter. Which premium structure best matches this illustration? A. Level premium whole life. B. Graded premium whole life. C. Modified premium whole life. D. Indeterminate premium whole life. The correct answer is B. The correct answer is graded premium whole life because it features lower initial premiums that gradually increase over a set period until reaching a fixed level for the remainder of the policy's life. Reason A is not correct. Level premium whole life has the same premium amount from the start of the policy and does not increase during an initial period. Reason C is not correct. Modified premium whole life starts with reduced premiums for a limited period and then jumps to a higher fixed level without gradual increases. Reason D is not correct. Indeterminate premium whole life allows premiums to fluctuate based on insurer experience, rather than follow a predetermined graded schedule. Question 6. An insurer offers a whole life policy with a guaranteed maximum premium, but reserves the right to reduce future premiums if its mortality and expense experience is more favorable than expected. Which type of premium design does this describe? A. Graded premium whole life. B. Modified premium whole life. C. Level premium whole life. D. Indeterminate premium whole life. The correct answer is D. The correct answer is indeterminate premium whole life, since it guarantees a maximum premium while permitting the insurer to adjust actual premiums downward based on its financial experience. Reason A is not correct. Graded premium whole life features predetermined increases, not adjustments based on actual insurer experience. Reason B is not correct. Modified premium whole life simply offers reduced premiums for an initial period, followed by a fixed higher amount without variable adjustments. Reason C is not correct. Level premium whole life sets a fixed premium amount that does not change, unlike a design that allows downward adjustments. Question 7. Which of the following best describes the coverage period feature of a level term life insurance policy? A. The policy accumulates cash value that can be borrowed against after a set number of years. B. The death benefit declines over the duration of the policy in line with an amortizing loan. C. The death benefit and premium remain consistent throughout the specified term. D. Premiums increase annually while the death benefit remains fixed until term expiration. The correct answer is C. A level term life insurance policy guarantees a fixed death benefit and level premiums for the entire length of the chosen term, ensuring consistent coverage costs and benefits throughout the period. Reason A is not correct. Level term insurance does not build cash value, it provides pure risk coverage. Reason B is not correct. Declining death benefit is a feature of decreasing term insurance rather than the level term. Reason D is not correct. Premiums remain unchanged in level term policies. They do not escalate annually. Question 8. Which feature most accurately defines a decreasing term life insurance policy designed for mortgage protection? A. Annual premiums decline over the policy term. B. The death benefit decreases in proportion to the outstanding mortgage balance. C. Cash value accumulates to cover future interest payments. D. Premiums escalate to offset rising interest rates. The correct answer is B. A decreasing term policy used for mortgage protection aligns the death benefit with the outstanding mortgage balance by reducing the death benefit over time, while level premiums typically remain constant. Reason A is not correct. Premium amounts usually remain level in mortgage protection term policies rather than declining. Reason C is not correct. Decreasing term policies generally do not build cash value. They provide pure term coverage linked to a loan balance. Reason D is not correct. Premiums remain constant in most decreasing term mortgage policies and do not escalate to match interest rates. Question 9. Which characteristic best describes an increasing term life insurance policy with cost of living adjustments? A. Premium payments decrease as the policy term progresses. B. The death benefit rises periodically based on a consumer price index. C. A guaranteed cash value is added each year. D. The death benefit remains fixed but premiums adjust for inflation. The correct answer is B. An increasing term life insurance policy with cost of living adjustments increases the death benefit periodically in accordance with an inflation index, such as the Consumer Price Index, while premiums may remain constant or adjust minimally. Reason A is not correct. Premiums and cost of living term policies typically remain level or adjust minimally, not decrease. Reason C is not correct. These policies do not build guaranteed cash value, they only adjust the death benefit for inflation. Reason D is not correct. The death benefit in cost of living policies increases rather than staying fixed when inflation adjustments apply. Question 10. A 35-year-old insured purchases a 20-year level term life policy with a return of premium term rider. At the end of the 20-year term, the insured is still living and elects not to renew. Which of the following correctly describes the rider benefit? A. All 20 years of premiums paid are returned tax-free. B. A percentage of premiums is refunded based on attained age. C. No refund is available because term policies lack cash value. D. The refund equals the policy's cash surrender value. The correct answer is A. The return of premium rider entitles the insured to receive a refund equal to all premiums paid at the end of the term, and these refunds are generally received income tax-free since they are considered return of capital. Reason B is not correct. Return of premium riders provide a full refund of premiums paid, not a percentage tied to attained age. Reason C is not correct. While term policies lack cash value, the rider creates a separate refund feature independent of cash surrender value. Reason D is not correct. Refunds under this rider are the total premiums paid, not the policy's cash surrender value. Question 11. An insured holds an annual renewable term policy that includes a conversion privilege. Which statement best describes this conversion feature? A. The policy owner may convert to a permanent policy without proof of insurability. B. Conversion requires submission of evidence of insurability. C. Conversion must occur within the first policy year. D. Converted premiums are based on the original issue age. The correct answer is A. The conversion privilege on an annual renewable term policy allows the policy owner to convert to a permanent plan without providing evidence of insurability, with premiums based on the insured's attained age at conversion. Reason B is not correct. Conversion privileges waive evidence of insurability, so proof is not required. Reason C is not correct. Conversion periods typically extend beyond the first year under the terms of a conversion privilege. Reason D is not correct. Premiums for the new policy are based on attained age, not original issue age. Question 12. In a fixed annuity contract, the accumulation phase primarily refers to the period when A. An index formula is applied to determine interest credits based on equity performance. B. Premium payments earn interest at a guaranteed fixed rate prior to annuitization. C. The contract's cash value is at risk of decline due to market fluctuations. D. Periodic payouts are distributed to the annuitant according to a payout schedule. The correct answer is B. This option is correct because in a fixed annuity, the accumulation phase is when premium payments earn a guaranteed fixed interest rate before annuitization. Reason A is not correct. This describes indexed annuities rather than the fixed interest accumulation period. Reason C is not correct. Fixed annuities are not subject to market decline during the accumulation phase. Reason D is not correct. This refers to the payout phase, not the accumulation period. Question 13. In an equity-indexed annuity contract, the participation rate determines which of the following? A. The portion of premium invested directly in an underlying equity index fund. B. The minimum guaranteed interest rate regardless of index performance. C. The percentage of index gains used to calculate interest credited to the annuity. D. The annual cap on index returns applied to interest calculations. The correct answer is C. This option is correct because the participation rate specifies the portion of the index's gain that is credited as interest to the annuity. Reason A is not correct. Premiums in indexed annuities are not directly invested in the index. Reason B is not correct. This describes the guaranteed minimum rate, not the participation rate in index gains. Reason D is not correct. The cap rate limits credited interest but is distinct from the participation rate. Question 14. Which statement best describes the purpose of the separate account in a variable annuity contract? A. It guarantees a minimum interest rate regardless of market performance. B. It holds assets backing variable benefits segregated from the insurer's general account. C. It commingles assets with the general account for its statutory reserve requirements. D. It credits returns based on participation in a stock market index. The correct answer is B. This option is correct because a variable annuity's separate account is used to segregate assets backing variable benefits from the insurer's general account. Reason A is not correct. Guaranteeing a minimum rate is not a function of the separate account. Reason C is not correct. Separate accounts are segregated, not commingled for reserves. Reason D is not correct. This describes indexed crediting, not the separate account function. Question 15. A 65-year-old retiree is considering an immediate life annuity and wants to ensure that if death occurs within the first 15 years, payments will continue to a beneficiary for the remainder of that period, but will otherwise last for the retiree's lifetime. Which payout option best meets this goal? A. Straight life. B. Life with refund. C. Joint and last survivor. D. Life with a 15-year period certain. The correct answer is D. This option guarantees payments for at least 15 years even if the annuitant dies early and then continues payments for life if still living beyond that period. Reason A is not correct. Straight life ceases payments at the annuitant's death with no guarantee to a beneficiary. Reason B is not correct. Life with refund returns unused purchase amount rather than providing continued periodic payments over a fixed period. Reason C is not correct. Joint and last survivor ensures payments while either of two lives exists, but does not guarantee a minimum period to a beneficiary. Question 16. An owner buys a deferred fixed annuity with a 10-year surrender charge schedule, starting at 9% in year 1 and declining by 1% each contract year until 0 in year 10. The contract also allows a free withdrawal up to 10% of the accumulation value annually. At the start of the 5th contract year, the accumulation value is $120,000, and the owner withdraws 15% of that value. What surrender charge will be assessed on this withdrawal? A. $300. B. $600. C. $720. D. $1,200. The correct answer is A. The owner withdraws $18,000. $12,000 is free, leaving $6,000 subject to a 5% charge in year 5, resulting in a $300 surrender charge. Reason B is not correct. This assumes a 10% charge on the amount subject rather than the scheduled 5%. Reason C is not correct. This applies a 6% rate to $12,000 rather than the correct 5% to $6,000. Reason D is not correct. This represents the full free withdrawal amount rather than the actual charge on the excess withdrawal. Question 17. Which contractual provision in a life insurance policy precisely states the insurer's commitment to pay the death benefit upon the insured's demise? A. A section detailing the conditions for any attached riders. B. A clause specifying policy exclusions and coverage limitations. C. The insuring clause that outlines the promise to pay upon death. D. A paragraph describing beneficiary designation requirements. The correct answer is C. The insuring clause is the core provision in which the insurer formally promises to pay a specified benefit upon the insured's death. Reason A is not correct. It focuses on riders rather than the insurer's core promise and payment obligations. Reason B is not correct. It relates to exclusions and limits, not the primary promise to pay benefits. Reason D is not correct. It addresses beneficiary details instead of the insurer's payment commitment. Question 18. Under Wyoming statute, what is the minimum free look period granted to a policy owner after delivery of a new individual life insurance policy? A. 5 days. B. 20 days. C. 30 days. D. 10 days. The correct answer is D. Wyoming law requires insurers to provide at least a 10-day free look period during which the policy owner may return the policy for a full refund. Reason A is not correct. A 5-day interval is shorter than the statutory minimum and therefore incorrect. Reason B is not correct. A 20-day period exceeds the minimum required under Wyoming statute. Reason C is not correct. A 30-day span is longer than the mandated free look and not the minimum. Question 19. Satya, what is the statutory minimum grace period that must be offered for a life insurance policy with premiums payable monthly? A. 45 days. B. 31 days. C. 30 days. D. 60 days. The correct answer is C. Statutory requirements mandate a minimum 30-day grace period for policies with monthly premium payments before a lapse can occur. Reason A is not correct. A 45-day period exceeds the statutory minimum required for monthly premiums. Reason B is not correct. A 31-day grace duration applies to other premium modes, not monthly. Reason D is not correct. A 60-day interval is longer than the minimum period mandated by statute. Question 20. An insured's whole life policy lapsed after non-payment of premiums. 6 months later, the insured submits a reinstatement application, a statement of good health, and payment of all back premiums plus interest. The insurer approves pending one additional requirement. Which of the following must also be satisfied for the policy to be reinstated? A. A new medical examination at the insurer's expense. B. Completion of an updated beneficiary designation form. C. Assignment of any accumulated dividends to offset past due premiums. D. Repayment of any outstanding policy loans plus interest. The correct answer is D. The correct answer is repayment of any outstanding policy loans plus interest, because reinstatement requires payment of all lapse-related amounts, premiums, interest, and loans, in addition to satisfactory evidence of insurability. Reason A is not correct. A medical exam is not required if proof of insurability has already been provided. Reason B is not correct. Updating a beneficiary designation is not a condition for reinstatement. Reason C is not correct. Accumulated dividends may be applied toward premiums, but are not mandatory for reinstatement. Enjoy this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.